All right. So welcome back, everybody. Hopefully you guys are within earshot. We are at 10:35 and we're in for a treat. We're going to hear all about trust and trust management. And I sighed there because I'm always surprised at the different flavors that we have of these trusts. And we'll learn a little bit more about why that's the case shortly. So I'll stop talking and I'll introduce to you our two presenters for this later part of the morning, Bryn Siegel and Tami. Tami, I don't think I ever learned how to say your last name.
Calkin.
Calkin, thank you.
It's the easy way.
Excellent, thank you. Both of them are joining us from Oregon Pacific Bank, and where they work in the trust management office. And with that, I'll stop talking and I'll turn it over to you guys.
Thanks, Sam. We really appreciate you including us in this presentation. And I thought this was a great way to, explain a little bit about charitable remainder trusts. My background, I did work at the CSU for a couple of years, and I was in the tax, mostly the tax role, but I got to work with Erin closely and Lori Redfern and the foundations, the auxiliaries and everything you guys do with planned giving was interesting to me. And so I reached back out, wanted to reconnect with the CSU and try to, see if there's any way to, impart some knowledge that just gives you the tools to know how to use these things. Obviously, you're going to have to work with attorneys and different partners to get them going. But, it's great if you just understand the roles of a trustee. I know that the CSU typically doesn't take on that role. A lot of nonprofits do. So it's great to work with partners. And so I'm up in Oregon now. So with Oregon Pacific Bank, I work with Tami, who's in the Eugene office. And I'll let her tell you a little bit about herself.
Yeah, so I've been at Oregon Pacific Bank for a little over a year now. Prior to that, I was at the University of Oregon Foundation for almost 10 years. And I was the primary person that did all planned gifts, large gifts, unusual gifts, oddball, stuffed animal type gifts, random coins, so those things. I also represented the university and the foundation for estates. We carried a portfolio of about $100 million in charitable trusts, so I administered those on behalf of the foundation, and then made the shift to a corporate trustee about a year ago. So I'm excited to be with you guys today. Basically, we're going to go over kind of some of the different flavors that Sam was talking about with the trusts and why understanding, the different roles and what those flavors are can help you get some of these gifts, because they're amazing big dollar gifts that can really benefit your organizations. While I'm going through this, I'm going to kind of buzz through the information, but if in the chat you want to throw any questions, at the end we tried to save some time so that we can get into some discussion. So if you want to kind of table any questions just so you don't forget them, please feel free to do that in the chat, and then we'll go back to Q&A, because that's usually where the interesting stuff comes up anyways. So without any further ado, okay, so the best part about these gifts is you don't have to be an expert on them to really receive the benefit. Knowing just enough to know when to raise your hand or when to point your donors at one of your community partners is really all you need to get this process started. In fact, you don't want to be their attorney. You don't want to be their CPA. You don't want to know too much, so that you are pointing them to the appropriate people. So knowing who those people are in your neighborhood, within your donor base, in your community, is the first place to start. You want attorneys that are friendly to charitable giving, that understand, that are estate planning attorneys, that can really help your donors walk through the process and different options and be knowledgeable enough to explain the different options and the pros and the cons so that your donors can make an educated decision. CPAs are a really important part of the piece because they kind of can understand the tax ramifications of all the different options. And when attorneys aren't necessarily philanthropically inclined, shall we say, as they're going through the estate planning. Maybe they're more focused on, yeah, you're going to leave it all to the kids, right? The CPA can kind of keep going back to well, they have some philanthropic interest. How can we do both? Community foundations are another important partner. One, because a lot of times they will take on gifts when you don't want to. Meaning, if there's a gift annuity that wants to fund with an asset that CSU isn't comfortable taking, maybe they want to fund a gift annuity with property or a restricted stock, or they want to do a trust with complicated assets that CSU can't. A community foundation sometimes will take those on, whereas you can't. Because as you know, with an annuity, there is a risk involved with that. If it exhausts, if it whatever, it actually becomes a liability. So if they're willing to take on that liability as opposed to your organization, a lot of times that's a very worthwhile partnership. They can also help your donors that want to do things like donor advised funds, but having those good relationship with a community foundation partner can make sure that those gifts stay pointed your direction. Professional trustees like Bryn and I, as of course an important partner too. One, for the administration of charitable trusts, if it's not something that you're going to do yourself, or the donor wants an outside person to do it. And also because we can administer not just charitable trusts, but living trusts as well. So if you have a donor that's particularly susceptible to elderly abuse, maybe they don't have a family member that's helping watch them, but they have a charitable gift in their estate, you guys have a vested interest in making sure that, that they're taken care of and their funds are handled properly. Unfortunately, about 65% of adults in the US will experience some sort of elder abuse. So having a professional trustee monitoring the finances of your donor base is a really big benefit for you and for them. All right, let's go to the next slide. So charitable trusts tend to be large gifts and very committed donors. They aren't your casual donor that just showed up at an event, gave some money because they had too much to drink and moved on. They're the ones that have long invested relationships with your organizations. They really care. They're the donors that give you, maybe they only give you $100 a year, but they give it to you for 30 years straight. And then at the end, you get this wonderful, we always call them the happy sad of, they died. We never knew they had giving capability. And all of a sudden we get this big check. These are those donors that will do charitable trusts. And as you can see, charitable trusts tend to be the biggest gifts that donors can give. If it's a charitable trust, it tends to be worth your while. Yes, it's more hassle than just getting the happy, sad check when they die, but you also have the long relationship of when they're getting paid out from the trust.
Yeah, and just to add, one of the reasons why a charitable trust will tend to be so much bigger than a gift annuity is because they're more complex, right? So typically, they're more specific for that actual, funds that are transferred. It's usually an appreciated asset. And so it's usually a pretty big asset. So, just something to think about, considering why you would use a charitable trust versus a gift annuity.
So 91.6% of donors will work directly with attorneys to set up a charitable trust. They have no expectation of you guys providing that service. So not being able to do it in-house is not a detriment in most cases. Only 30.7% consult with the nonprofit during the process. They might let you know at the end or beginning, but they're not expecting you to provide their legal and their CPA advice. So not being scared that you can't provide that service is definitely shouldn't be a stumbling block for you, because that's not the donor's expectations. What's going to best enable you to get these gifts is knowing when to refer them to someone, and then who to refer them to. Be a resource for the donor and their team, stay involved in the discussion, and then steward your donor appropriately afterwards. Even though you don't have a check, you have a committed gift. And these folks, because of their loyalty, their long-term commitment in general to your organization, how they expect to be stewarded can sometimes be a little different. They want more information about the charity and less thank yous, tchotchke, those kinds of things. So knowing who these donors are and what their expectations are can help make sure that the gift stays with your organization. Okay, so the flavors that Sam referred to is kind of the alphabet soup of trust. You hear Krutz and Kratz and Klutz and all sorts of things. So what each of those letters stand for basically kind of tell you some of the iterations of it. So the C at the beginning is the part you care about. There's a charitable element that is irrevocable. So yay, if it's got the C, that's a good trust. The second letter talks about what portion of it is charitable. So when you talk charitable CRT, that's a charitable remainder. So the charitable portion of the trust comes at the end. Whereas a charitable lead trust, the charitable portion is at the beginning. So what does that mean? A charitable remainder trust, you have this donor and they have this hunk of assets, whatever they may be, whether it be stocks or property or cash. And then they put this into the charitable remainder trust. It becomes its own standalone entity. It has its own tax ID. It has its own tax laws that are different than individual tax laws. And then it can pay back to the donor, heirs, friends, whoever is set up in the term of the trust for either their lifetime or a period of years. It might be a 5-year trust. It might be a 20-year trust. You're not going to see longer than that if it's just a period of years. And then at the end, so that bucket of assets is managed. It makes these payments out, and then whatever's left in the bucket at the end, that's what goes to the charity. And it could be one or more charities, whatever is set up within the trust document. So the charitable lead trust, on the other way, you still have the donor with the bucket full of something. They're going to stick it into the entity. It has its own tax ID, own tax rules, but then it's going to pay out to one or more charities for either the donor's lifetime or a period of years. And then what's left in the bucket at the end, that's what goes either to the donor or most often to the heirs. So why the difference? Why would one person choose one over the other? Thinking about a charitable remainder trust, 95% of these trusts are, and will you back up one, Sam? Sorry. 95% of charitable trusts are these. This is kind of what most people think about. It's taking a basket of assets, converting it into retirement income, and then what's left at the end of their lifetime, that's what goes to the charity. Most of the time, that's how these are used. So the donor may have a concentration in a particular something that they want to diversify, but maybe they have low cost basis. Maybe they were paid in stock for one of their jobs. So they have a large number of Microsoft or Nike or one particular stock that they want to be able to diversify, but would incur a lot of capital gains. So instead of doing that, they place it into this basket, and then the basket, because it is a charitable entity, can sell it without realizing all those capital gains right at the get-go. It can move into more diversified portfolio, make less risk for the donor overall. It's converted to retirement income, and then there's also at the, right as you're nearing retirement, a lot of times that's when your earnings are the highest. So getting that immediate tax benefit for the gift that's later going to go to charity. So that's how those have been traditionally used. The lead trust, on the other hand, is I have this thing, I don't need it, I don't want it anymore, but if I give it to my kids, I'm going to get a whole bunch of taxes. So what they do instead is they put it into that basket, and you can structure these as either a grantor and non-grantor trust. So and between the two, you're either saving on estate taxes or kind of current taxes. But say you own a warehouse, it's worth $1 million. You get about $66,000 in rent out of it. And you want to set it up into this trust, and it's going to pay out to Cal State Fullerton for a period of years, 10 years. You were up there, Hart. So you get the gift. Way to go. So it's going to pay $50,000 out a year to Fullerton for those 10 years. So, and it'll do that through the lease payments it's receiving, the $66,000. And at the end, the building that may be worth more than $1 million now because it's appreciated in value, and the excess income will pass to the heirs, but it will do it at a discounted amount. So the gift tax isn't as much as if they had just given the building over to their kids. And the reason for that is the IRS sets that IRS discount rate, and right now it's at 1%. So the IRS thinks you're only going to make 1% on this $1 million building for the next 10 years, say. And so it's assuming you're going to make $10,000, but you're going to pay out $50,000. So it's going to calculate that the value to your heirs is going to be much less than it will be at the end. In theory, unless the real estate market crashes, blah, 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 all those lovely disclaimers. But most of the time it works out as a much lower gift tax rate and a way to pass to your heirs and avoid estate tax altogether. So it's kind of two different ways. Charitable lead trusts tend to be much bigger because you're talking big assets, complicated assets, and setting these up is not something that you can do quickly and easily. People aren't going to do it for $100,000. They're going to spend more on legal than it's worth.
Yeah, and I know these charitable lead trusts are really popular right now with, a lot of younger people that are, getting, into these .coms, and, they grow really quickly, and all of a sudden they have this huge asset that they don't have a need for currently, and they don't want to pay tax on it currently because it will just be a huge tax rate increase for them overall. So that's, just, it's good to know the difference between a lead trust versus a remainder trust, because it's probably a different pool of people that'll be thinking about one versus the other.
Absolutely. All right. So the next letter in the alphabet tells you, go one more slide, Sam. So unit trust versus the annuity trust. So you've got the C and you've got the R or the L, and then the U or the A is going to tell you how those payments are calculated to be made each year. So a unit trust pays a set percentage of the market value revalued annually. So on 12/31 every year, you're going to say, okay, what's the value of the trust today? Great. That's the percentage I'm going to pay out for the next year. And then the next 12/31, you do the same thing. Say it's a 5% trust. So that payment amount could vary every year. It will, based on what the market value it is. An annuity trust, on the other hand, is a set percentage of the market value on the funding date. So you put in $1 million, it's a 5% annuity trust, you're going to get $50,000 a year, no matter how much is in that trust for whatever the term of the trust is. So there's upsides and downsides of this, and depending on your donor and the situation, there's going to be more payment volatility with unit trusts, but because it's revalued annually, they can keep adding to those trusts. Whereas an annuity trust has one funding date, one funding amount, so adding to them is not allowed. So there's more flexibility for funding over time with a unit trust. Donors, on the other hand, that are very... I'm sorry.
Yeah, if you're, probably everyone's more familiar with gift annuities than they are with charitable remainder trusts. So a CRAT or a CLAT, that's going to be more like what you probably are familiar with. Whereas, a CRUT or a CLUT is going to have that unit trust aspect that might be a little different.
Yeah. So donors that are really sensitive to volatility might be more, an annuity trust might be more appealing to them. Maybe they're funding it with the idea that this is going to pay this amount to, a set amount, and they're comfortable with that set amount. So kind of looking at how these scenarios play out for the donors, I think is helpful in understanding it. And on this next slide, I have 3 different scenarios so that you can kind of look at what does that actually feel like to a donor and what does it mean for you guys. So on the bottom scenario, that's the one that's never in a million years going to happen. That's a perfect world if it grew 7% every year and you pay out a 5%. So I took a $1 million trust. It's got a 5% payout. If it's an annuity trust, they're going to get that $50,000, that gray line, $50,000 a year over this 10-year period, no matter what the market value does. If they were in a unit trust, their payment would do what the orange does. it would go up a little bit because it's paying out 5%, but it's returning 7%. So the market value of the trust is going to go up, so will their payments. So giving you guys an idea of this, at the end of the 10-year period, if they went with the annuity trust, and it would be $550,000, so 11 years worth of payments to the donor. If in the annuity trust. In the unit trust, they would have gotten $608,000 worth of payments. The gift to you with the annuity trust would have been $1,276,329 versus the unit trust would have been $1,218,994. Both are great gifts. Both are great scenarios, but this is never going to happen because this isn't how the market works. But it is something to show to donors to get an idea of annuity versus unit trust. So the scenario on the top right is if there's a large drop in year 2 and 3, a very slow recovery, and then a bump at the end. So this is kind of a worst case scenario or a not very favorable outcome. So if they're in the annuity trust, again, it would stay with $50,000 no matter what, versus the unit trust, their payments would go down. Maybe they were banking on $50,000, but this donor at one point is only going to get $32,000 in a year. They might not be very happy with that. They've got to be comfortable that this could happen. Over the life of the term, in the annuity trust, they would have seen $550,000 in payments, whereas with the unit trust, they're only going to get $446,000. That's a big difference for the donor. And then for the charity, in the annuity trust, you guys are going to get $894,837 versus in the unit trust, you'd get $1,094,000 and change. I'm not going to read the rest of the numbers, but you can get an idea of, because it cuts farther into the principal for them with the annuity trust to pay out $50,000, it's a higher percentage when that market value is lower. So, and then on the left side, that's more if there's an early jump and a late drop, so kind of the inverse of that scenario. And there, with the annuity trust, you guys would get 1.3, and with the unit trust, you get 1.1 as your remainder. And you can see that what their payments do. Their payments, they'd be better off with the unit trust. But there's a range. I mean, nobody's crystal ball, nobody's magic 8 ball is going to work. No, the donor has to be comfortable with that volatility to be comfortable in a unit trust. So there's other types of trusts in that alphabet soup that you'll see. If you flip to the next slide, Sam. So a NIMCRET or a NICRET, which are just great names, but they just mean that it's a net income instead of like a set percentage for, and it could be for part of the term or all of the term. So it can be structured, and the M in there is whether there's a makeup or not. So the NI is the net income. Sam, can you go to the next slide? Maybe. So basically, a lot of times these are great if you're funding with an asset that's not very liquid. Maybe you're putting in a property and you're just going to pay net income out until the property sells, and then it's going to flip over and convert to a standard payout. Or you could have somebody that started the .com, you know, a startup business, and they have this asset and they don't really want to get a whole lot of income at the beginning of the trust, and they want to get a larger amount later. So they might do a net income trust so that they're getting the income now, and then they specifically invest in a way to minimize the income. And then after it flips at a particular date, then they can get a higher payout. So this can be used for a younger person who doesn't want it until later, like Bryn was talking about earlier. So if you ever hear testamentary trust, that just means it was funded through an estate. It's a big word for a fairly simple concept, just because lawyers like that. Sorry, Bryn. Trust term, the thing to think about there, it's set by the trust document. It can be a period of years, up to 20, or it can pay to someone for their lifetime or successive lifetimes. So somebody could set it up to pay to themselves, then to pay to their children, and then roll to charity. So it can have 2 people in succession. So funding considerations. Sam, are we frozen with the slide deck?
I'm wondering if Sam is frozen. Let me see if I still have host and can help. I don't think so. I will send him a message.
I just sent him a message and he didn't respond, so I assume he's probably frozen.
Okay. And guys can give you guys a copy of the slide deck too, so you'll have the notes later. So with funding considerations, kind of this is just red flags, things that you might hear that would raise oh, this might create a problem in a trust. Have you consulted with your attorney or your CPA if you hear a donor talking about this? So the most common funding comes from appreciated public securities, cash, and then property is a distant third. So with property, you need to make sure that mortgaged real estate should never be put in a trust. Yay. Or no property that already has a prearranged sale. If they come to you and say, hey, I have this, now I have this great offer. Then I started looking at taxes. I'm going to put it in a trust first. If they've already accepted an offer on the property or somebody has behaved in a way, you're talking prearranged sales and you could lose the whole charitable thing. It could nullify the trust. So huge red flags there. UBTI is, remember I told you the trust is its own entity and has its own tax rules. Under those tax rules, UBTI is 100% excise tax. So something to be avoided at all costs. So making sure you don't have any S Corp shares going in there. But again, just looking at when do you point them at a CPA or an attorney, just know that these are red flags. I wouldn't give them advice related to that.
And just real quick, some people might not know what UBTI is. It's unrelated business taxable income. And so you might all be familiar just because, it's the kind of the known thing within the CSU that if you have UBIT, usually people say that's where you have to pay tax. So
yes, very, very bad in a charitable trust situation. So logistics of this. So you have this, donor that's talking to you about a situation. You point them to your attorney, to their CPA. They're going to go ahead and do this. Charitable trust, 57% of donors are going to end up acting as their own trustee. 21% will ask a nonprofit to be the trustee, and the other 21% use a professional trustee. If your nonprofit doesn't offer that service, understanding the other two options and what might make sense for your donor is great. Having professional trustees you can refer them to that you have a good relationship. Once that trust is established, it's its own entity. It has its own reporting requirements, its own tax returns. And if you are irrevocably named in there, you become a party to this. It becomes something that could go on your books. It's counted. It can be accounted for if it's irrevocable. So understanding and monitoring it, making sure that the donor what's going on with the asset so that you know who to contact when it's time, when you get the sad happy call or the happy sad depending on the situation. So again, if your charity is irrevocably named, that's a gift. At the time the trust is funded, that's the gift date. CASE and FASB allow for that to be counted at face value with a present value calculation that could either go through Crescendo or PG Calc or whatever software you're using there. And it's going to go on your books. So annually, you're going to check in with those donors around audit time. You'll have that ongoing relationship opportunity there. The donors or whoever the trustee is legally required to report to you how that trust is doing. So if you ever get a statement and you don't know why you're getting this statement, a lot of times it's this situation that you've been irrevocably named. You have to get some sort of notification, but reaching out saying, hey, why am I getting this statement? It is a really great stewardship opportunity to engage that donor to build on that relationship. So if you're revocably named, meaning you're in there, but they have the right to change their mind, you can still count it and do a present value calculation. But FASB doesn't allow it to be accounted for as an asset of your organization, but it's still a gift for case standards. Does that make sense? Any questions on the nuance there?
Yeah, and then also just to add that one of the ways people are right now, a popular strategy right now is using donor advised funds as the charity. And so in that example, usually the person's doing it so that they can trade the charities in and out and have a lot of flexibility, because they don't have to go back to their attorney to change the name of the charity listed. So that's something people are doing frequently, and that's a situation where it's probably going to be an irrevocable, a revocable trust as opposed to irrevocable.
Yeah, 77% are revocable according to the recent studies done on that. But it gives you an idea of the importance of stewardship with these donors, and that they want that engagement. They want to be able to still have their hands in the pot during the length of the trust.
And also something that can get confusing here too is, I think we said at the beginning that a charitable remainder trust needs to be irrevocable. So the trust itself is going to be irrevocable. It's just whether you can trade in and out the charities. That's the only part that you can typically make changes to.
Yeah, exactly. So I have seen trusts for any manner of things. I've seen them to pay a pension to a long-term employee. I've seen them to fund a neighbor's college. Here's a term trust or whatever. I've seen them used to pay alimony or child support to meet that obligation. Paying a friend, spendthrift kids. There's all sorts of options for how all these trusts can be used. And just thinking creatively can help you get some really amazing gifts.
Okay, now we're going to talk about private foundations and endowment funds. So these are really just trust vehicles that are a pretty simple trust. Well, I guess an endowment fund would be a simple trust, whereas a non-operating private foundation can be kind of complex, actually. And this is where you really want to work with partners. You need a trustee that can do all of the work that's involved. You need to file a 990 PF, the private foundation tax return. You need to avoid self-dealing transactions, and you have to make sure that you do an annual distribution of at least 5% of the assets. And then there's an excise tax on investment income. So, a non-operating private foundation works just like a private foundation, except that a non-operating means that it typically just is a vessel to distribute out. So they're not doing any operations themselves, they're just distributing out. And so, somebody who has a lot of money, or maybe a group of people will come together and put together a private foundation. And, that's a great way that the CSU can be named and be a part of a great gifting strategy. One thing to be, in the know about is that states often have registries as well. So there's all those IRS reporting requirements. And then also California and Oregon and many other states will have their own requirements to register and maybe do an annual update so that the state is informed. Basically they just want to check in and make sure that it's all happening in the interest of the charity that's involved. And then endowment funds. So an endowment fund is just your typical trust. It's just set up, primarily for growth. So you can put, a large amount of assets in there and then hope that every year there's enough income to distribute out, and then the principal can keep growing. So, these things can go on forever. When I was a trust officer previously at Wells Fargo and focused on philanthropic trusts. And there we had some really interesting accounts that went back hundreds of years. And so, you saw these trust agreements that were drafted, by some attorney on a typewriter. And, oftentimes they are universities. Usually it is a philanthropic intent to, provide education for the next generation. And so they'll set up scholarship accounts. You're probably all very familiar with these because you deal with the scholarship accounts. And it's either the universities or the high schools that are going to pick those the students that are going to benefit, or sometimes there's a committee within the scholarship fund itself that picks. So those are private foundations and endowment funds.
So the Secure Act in 2019 eliminated the stretch IRA, which created kind of this opening for charitable trusts to be the recipient of IRA death benefit. Because previously kids could elect to take the IRA, make it their own, and spread it over their lifetime. It would also stretch the taxes over their lifetime. Instead, you have a situation where if somebody lives to a ripe old age of 85 or 90, and then their kids are inheriting it at 55 or 60 when they're in their peak earning years, now they have to take it all within 10 years and pay all the taxes within 10 years. Not ideal. Also not ideal if you are concerned that even they could stretch it over their lives, they wouldn't necessarily do it. They might elect to spend it faster than the person that is deceased would want them to. So with the rise of charitable trust being this beneficiary, you also have this opportunity because basically the IRA can now feed 100% of the money into the charitable remainder trust, which is that separate entity, and then it can stretch payments out over the lifetime. There is also some tax benefit for the initial funding event, and it forces the stretch. Whereas before the kids were on kind of an honor system to stretch out those payments, you now have it enforced by the parents, which has been a huge emotional benefit for donors that have gone to this. If they don't have to worry about their kid making a different determination. Even if they had a letter in there saying that they wanted them to stretch, they didn't have to. And this also means that the leftover can go to the charity of the parents' choice. So there's been some emotional benefit with this, that even if it changes, I don't see CRTs going away as a beneficiary of IRAs because of some of the family dynamics and the options to account for spendthrift kids. It's kind of created this wonderful dynamic for parents and this option. So getting comfortable with what those rules are, and if somebody brings up, the Secure Act or whatever, having those talking points of, have you talked about this, being a really great option. So, sorry, I kind of buzzed through two and one.
Yeah, and with that Secure Act, stretch IRA opportunity for CRTs, you don't need to know everything about the Secure Act. You don't need to know everything about IRAs. If you just kind of have it in your mind that these CRTs are an opportunity there, somebody might be speaking about IRAs, talking about, they're concerned that they're not going to be able to stretch them. They might be talking about they had this plan to give it to their children. They're rethinking it now. So just, I think just being aware and kind of knowing that that's an opportunity there. Then, you have your partners, you have CPAs and attorneys that you work with, and you can get them involved in the conversation just if you kind of hear people talking about these things.
And I'm just going to pause here because Wendy has a hand raised. And I'm back, guys. Sorry about that.
So just to clarify, so a person would be able to take their IRA and how would it, I've never done this, but I've heard of it, but how exactly does it work to become a CRT?
So I have an IRA that I've built over my working career. And then you set a payable on death beneficiary. And before, so say I would normally have set it for my kids. Now, instead of giving it to my kids, I will have pointed it to an unfunded trust. So I still have my attorney. So it's a separate entity. The IRA doesn't roll over or convert. What it does is the death benefit goes to that trust that was created before. And when a CRT has been created but not funded, there's not the tax reporting, that kind of thing. You don't have to do the ongoing monitoring. So you can have it built into your estate plan, and it basically pops into being when it's actually funded when you die and the IRA funds it.
Okay, thank you.
Okay, so now we're going to talk about some proposed tax legislation that would impact charitable giving. And this, I really just put on a couple bullet points here, and I want to emphasize that these are just proposals. There are things that, President Biden has put in the green book of, what he would like to see in a budget. They're not written into legislation yet. It's not assured that it's going to happen, and it would be pretty difficult to get either of these things across the finish line. But it's just good to know, and it's a little bit of a refresher of what we all just went over. So there's a proposal to treat donations to a split interest trust as a realization event. So a split interest trust is what we were talking about. A charitable remainder trust is a split interest trust because there's an interest for the individual who's not a charity, and they're going to get some income from it. And then there's the charity. So there's two interests. And right now it's primarily advantageous because of the opportunity to defer the capital gains. And so you're putting the capital gains right into that CRT. The CRT is going to deal with the taxes on that over a period of time. So basically, if you were to change that and call it a realization event, the donor would be taxed on the capital gains right there and then upon creating the CRT. So that's, obviously a negative for these type of vehicles, and, hopefully it won't pass. So it would be a negative impact on charitable giving. The other thing that's been proposed is eliminating the step up in basis upon death. So right now, somebody passes away, they have an asset, usually it's maybe a house they bought for $25,000. Now it's worth $1 million. The recipient does not need to pay tax on that gain. There's a proposal to trade this in for a different thing, which would be just a first $1 million of capital gains are excluded, and then everything after that would be taxable. So that would be a big change and definitely would impact charitable giving, kind of change the landscape overall. That's the very brief tax update. I did see we do have some questions. It looks like on the chat they've been sort of talked about, so we can kind of go over what was going on the chat while we were going through the presentation. So I think there was some conversation about the unit trusts and sort of the risk of a unit trust versus an annuity trust. So an annuity trust is more specific, right? You're saying that you're going to give, let's say, $10,000 a year for a 20-year period, and that's a fixed amount. Whereas with a unit trust, the amount's probably going to go down over time as you're using more and more of the funds that are in there. So there is a risk there. And, when I was a trust officer doing a lot of these type of trusts, we did frequently have calls from people that were very upset that the money was, the income recipients, they can get really frustrated when all of a sudden the money is just really small. And they, for whatever reason, just a lot of people are, especially if you're the beneficiary of something like this, you're not necessarily going to understand the dynamics. And so you start getting a check and you kind of just think that's going to continue forever. So it's good, good to know who are all of the players in this. You have your income beneficiaries, and sometimes they will have a vested interest that they are not that knowledgeable about. So.
And Bryn raises a great point in that your grantor, your funder, your donor is not necessarily the person that's going to be getting the payments. So you're having these conversations about, here's all the possibilities that could happen, given, our very best guess in our magic 8-ball that was $2.99. But you're not necessarily going to have those conversations with beneficiaries that aren't your donors, because your relationship is with your donor. And then a subsequent or a successor beneficiary could be somebody completely unknown with no emotional investment in your organization. The person that put the money in, that named your organization, they're the one that care about you. So somebody that might be receiving this wouldn't have the same emotional skin in the game, but they're still a beneficiary. It looked like there was some questions about negatives, positives, unit trust, annuity trust. And yes, Wendy is exactly correct. Unit trust, none of them are going to go negative. If they get to 0, the trust dissolves, it's done. So there's no risk to your organization. That, the worst case scenario is you don't get a gift, which isn't a great scenario, but it's better than an annuity where you get a big fat bill every year, as long as they live, when they live to be 120. I've seen annuities go under, and then you've taken on a liability for your organization instead of a gift. Whereas with a trust, it hits zero, you're done. Your liability became the time and effort you put into it, but hopefully you'll still have built that relationship. And I've had much more luck with donors when you have a conversation when they're starting to run out of money of, hey, this isn't going to meet your philanthropic goal of establishing the scholarship for, this program or this sort of student, that they will, reinvest, especially with a unit trust. Great, let's put our payments back in for a couple of years, let it get healthy again, or take out the payment, but then immediately make it as a gift back to the trust in a year where the market tanked so that they're not putting pressure on that trust. With an annuity trust, you can't do that. You can't put the money back in. You also have donors that if they wanted to make a gift of their income back, when you're talking an annuity, they have to go, if you're just doing a straight gift annuity, they have to prove that they have a normal lifespan. Not as easy as you would think for IRS standards. You go to doctors and no, I don't have a terminal illness. You have to jump through a whole lot of hoops and give up a whole lot of privacy to be able to write that off. Whereas with a trust, especially if it's a term of years, those kinds of things, it's a nice straightforward calculation that if they want to give up their income or their rights to it, they can get a deduction.
Yeah, and then I think there was also a question in there about whether you could continue adding to these trusts. So that's only a possibility for unit trusts and not for annuities.
So something else to think about is knowing if your donor has the possibility to give back to it, or you're going to want them to give back to it. Not that we all don't want more gifts, but if they're putting property in, houses don't pay bills very well. So you might need additional gift of cash to pay expenses of the trust, or a blended funding. Trying to get every single mutual fund and everything to hit on the same day for an annuity trust is tough.
Okay, and then Becky Brown from Fresno State asked, isn't there a certain percentage that goes to the charity at the end of the term to create the trust to begin with?
So the IRS requires that there be a 95% likelihood or greater that you're going to get at least 10% of the original funding amount. Otherwise, it doesn't qualify as a charitable trust.
So that's just what is, projected at the beginning of all this. So,
and to give you an idea, at the U of O, we had a program for a really long time. Over the course of 30 years, when we looked at it, we realized to 67% of the original funding on average, just to give you an idea. Keeping in mind, the 80s, people were real big on like 9% payout being sustainable forever. So that took a hit to some of our numbers. So, funding with stock is a lot easier to recoup higher percentages to. Funding with property sometimes can create challenges. There's more expenses involved with selling, those sorts of things. Looks like Wendy, you have your hand up again, or did it? Yeah.
So 2 questions. The first, because you mentioned this for the stretch IRA, being able to fund this with a beneficiary amount. I heard in a conference last week, you're able to do that too with the CGA potentially. So that's something I wanted to get more information on. And I didn't know if either of you had more information on that.
Interesting, because a CGA is a contract, not a trust agreement.
A testamentary charitable gift annuity.
Mm-hmm. I could
so
see
it would be funded with the beneficiary of the IRA,
mm-hmm.
and the gift date would be the date of death.
Interesting. Would the trustee or the executor of their estate be the one signing the contract then at that point, Wendy?
Well, you would do it
have
before, so the donor would do it and set it up, and then once the donor passes away, then the gift date would be. So I don't know the details yet. I just heard that last week, and I wanted to see if either of you had heard more information about that.
I haven't heard about that. My concern would be California has some beefy insurance, Department of Insurance rules with your CGAs, and how do you know when you're going to die? And the gift
Oh, you need
date
it?
and the
Okay.
funding percentage are essential parts by California Department of Insurance. They're essential parts of the contract. So to leave those up in the air might be kind of tough. I don't know. I don't know. Yeah.
Okay. And then the second part of that, because you mentioned the possibility of like a CRT if there's really no money left for the charity to make the gift, and a CGA, you can potentially go underwater. I'm trying to find more information about when to use a CGA versus a CRT. When is it more beneficial to do a CRT that makes more sense? So for us, we've had a couple of people who wanted to fund a CGA with $1 million, and because we only do 10% of any of our market pool, we're not there yet. So we are rejecting $1 million CGAs for these and asked them to do a CRT. So I think two parts of that is I feel like it is easier to just do a CGA through the contract, and that's probably why they want to do a CGA versus setting up a CRT. So kind of working through what you would talk to with the donor about that process. And the second part is what are really the benefits of doing the CRT instead, especially because you are taking a risk of making those annuity payments if it goes underwater for that big of an amount.
And you highlighted a lot of the pros and cons, and we had multiple donors that wanted to fund very large CGAs, and it comes down to, with the CGA, they have assurance that they're going to get payment for the rest of forever, but it only has the annuity option, not the unitrust type option. So there's potentially less benefit for them there, depending how the market goes. With that, we've also, so I mean, if they're looking for a flat amount, the CRAT, the annuity trust, can give them the same basically payment structure, but they're going to have more legal expense to set up, and they can't add to it, but there's no guarantee behind it. If the trust exhausts, it exhausts. Nobody gets paid at the end.
There's also just a ton more flexibility with charitable remainder trust or charitable lead trusts. So people tend to go to those when they have complex assets. Maybe they have something that they don't want to sell just yet. So they have a non-marketable asset, and in that situation, you could use the flip trust, where you wait a certain period of time before it becomes an annuity or a unitrust payment, right? So you have a ton of flexibility, and that's usually why somebody will go with a CRT, because, like you've both said, it takes a lot of time and energy. You have to have an attorney draft it. It's definitely the more complex option. So, typically you go with this if it's a bigger asset, it's more complicated.
So, and what you were talking about, Wendy, is you won't do more than 10%. It's concentration risk. If that's your one donor that lives to be 120, ouch to your poor pool. Another way to kind of mitigate some of that concentration risk too is to ask them to fund it over a course of years, because then you don't have as strong of a timing risk. Maybe they fund 200,000 over the course of 5 years. That way, if there's one market drop, but the others are going up, that can kind of balance out some of the concentration risk. I don't know what CSU's rules are with that. I mean, we had one donor that funded 27 different annuities. I could tell you everything from memory writing those contracts for him. And they ended up, because we had a cap, we wouldn't go more than $1 million for any one donor. But we made exceptions and let them go to 1.4 because they funded over a course of 30 years. So whereas they were the one annuity that we had that was underwater, it was funded in property at the worst possible moment. But overall, their 1.4 was still at 1.3 at the end. So even though we had the one underwater, and I think we ended up paying about $35,000 out of, as a liability on that one, that's another way to mitigate some of that concentration risk within annuities.
Okay, so unless there are any other questions, I guess there is a question here from Susan Berkman about 5% of the trust must be left to charity, but if there's only left, that doesn't leave very much. Essentially, there's nothing left. Yeah, okay, so
So-
that's just adding in.
Except, yeah, it's the original funding amount, not the end. So if it's a remainder trust, 100% of the remainder goes to charity.
Gotcha, yeah, that was a response to some other questions in the chat. Not a
Sorry, that a lot of
question.
the questions came in.
Yeah.
If we missed any of the questions, will somebody just shout out if we missed
Yeah,
yours?
yeah. Anything else?
I cannot get out of.
Was that somebody asking a question? Not sure.
That was Sam.
Sorry, am I still on off mute?
No,
Yes.
we
I
can
can
hear
hear
you,
you, Sam.
Sam.
I'm so sorry. I'm still running into tech issues. So let me log in and out one more time. But I want to thank you guys, if you guys can hear me, so much for imparting this really great information. The slide deck will be shared with the group shortly as well, since we had technical difficulties sharing that. And the last slide, of course, has both Bryn and Tami's contact information. So are you ladies okay with folks following up with particularly noodly questions?
Of course.
Absolutely, yeah.
Alrighty, so you guys, there you go. You guys have that resource, and I'll try to make sure that the recording is available up on our advancement intranet. If not, the slide deck is particularly informative, and then of course you have both Tami and Bryn ready to answer any questions.
Yeah, and just to close off, absolutely reach out if you have questions. And also, if there's one thing to take away from this presentation, it's just get to know your partners in the community. So, the type of attorneys in your area that do charitable remainder trusts, do a quick Google search and see who's out there for your respective cities. Check and see what kind of corporate trustees are available in the area, especially, a small bank like ours that has trust services. Usually it's more accessible than, like a big bank. Usually it's hard to call and talk to an individual, but the smaller the organization, usually the more hands-on you'll be able to get, your questions answered and that kind of thing. Tami, do you have anything you want to add?
No, good luck. Get big
All
gifts.
right. Thanks, everyone. Bye.
All right.